All right, good afternoon, and thank you guys for joining today. What we have is an opportunity to talk about business insurance. But before we do that, just a couple quick updates. So, send out the weekly newsletter, sometimes on time, sometimes maybe a couple days late. But this newsletter is a new format, so we have a new setup. And what my thought process is not only do we have this, just to go over a couple key items here. Once again, encourage anybody on your team to join with the new sign up link because once again we're doing meetings versus webinars. So the idea is to provide more opportunity to talk, to ask questions and things like that, in more of an open forum, and to provide collaboration opportunity. So if you miss any, we do have our site for all missed trainings. So you can subscribe on the YouTube channel, and you'll be able to see any old or prior meetings. Also going to open up a Telegram page. So the idea for that would be to basically provide quicker updates when needed. So we can do some announcements there versus through email. Some people just like getting information differently versus newsletters. So I'd like to meet people where they want to be. And so just click on the link. If you haven't downloaded Telegram yet, you can download Telegram. It's in any app store. You click there and you can dive right in. We are going to do some road shows again. So we're going to do the Great Collaboration Roadshow, but it's going to be on a more intimate basis. So if we scroll down here, we'll see our training today, which we're going to talk about key person, buy, sell, executive bonus plans. But coming up, we have some scheduled dates. So first and foremost, we're looking at doing a mini TGC, the Great Collaboration in Chicago, or specifically Naperville, on the 17th of August. And just got more of the details this week, so I'll be able to share those very soon. And the idea for this is really just to, you know, actually for agency owners, if you will, an opportunity for you guys to grow your team by inviting local people to these events. Gives them a chance to see the opportunities that we have at Valor with the different silos. So, talking about the life insurance, annuities, long term care DI, the ACA Medicare side, group life, group health, and then also the side with the alternative investment strategies. So many different ways you can make money. And we have about 30 seats available at this one in Chicago. Then we're going to take a week off and then go down to Orlando, then take another week or two off, I think, in between there, or and then head down to Dallas. So we'll go to Dallas again. Once again, it won't be a large one to scale. We're looking anywhere between 20 to 50 people, and it doesn't have to be licensed people, but I would say use this as an opportunity to bring those type of agents in so they could see all the different ways that they can make money through our platform and program. And then we're going to do one in Atlanta on the 21st. If you have different locations where you think this would be advantageous to help you grow, help your organization grow, let me know because I'm always willing to go to different areas. It just has to make sense. And if we can get at least 10 to 20 people, then that makes sense to me. You'll see we also have some information on the insurance side, annuities, alternative investments, health markets, and just some insights and additional opportunities in these newsletters. This as well from a weekly insights piece. My thought process is as followed. Uh, we as a team, as an organization, as an opportunity to grow our business, we can share posts, share links, opportunities. So if I see you guys put something out, I'll gladly share it, and vice versa. So we can do a grassroots approach and really grow this model from several different avenues. So that's what I would say is it's a great opportunity to see different ways to build the brand. So that's the newsletter just in a nutshell again. So again, we're going to be doing road shows. We got 4 on the docket right now. Uh, the event in Chicago, we have a confirmed location, so that'll come out soon. And Orlando, I should have something there. Dallas and Atlanta in the very near future. So we're going to create flyers for you to position with your teams if you want people to come to those events in those respective areas. So now we're going to move in. Those are just the quick announcements. Now we're going to dive into what we're going to talk about today. And thankfully, I have friends in different insurance companies, so I was able to get a pretty cool presentation from our partners at F&G. I'm actually going up to see my old internal wholesaler who is getting married um, Saturday. Yep, Saturday. So I'm going up to Cleveland to see Alex Voloshin. He was kind enough to send me this presentation deck to talk about, buy, sells, and key person and things like that. So um, a lot of our focus, when we talk about what we do here at Valor, is around the small business marketplace. And why is that? As you can see, there's over 33 million small businesses in the United States. Almost 100% of US firms have fewer than 500 employees. So when you think about that, what type of opportunities are available? It really touches the small business market. Now, we're not going to talk about it today, but things like 401k plans and things along those lines can fit right along with this idea and conversation. So as you see this, just understand that opportunity is knocking. So businesses obviously don't run themselves, owners do. And, when I stepped out of the corporate world, so to speak, and I moved into running my own business, I couldn't agree more. Working from, 8 in the morning till 12 at night every day is just one of those things where you are your business. The business doesn't run itself, owners do. And so when you think about that, it can offer some great rewards, as you see there. But challenges like COVID, hit a lot of small businesses. You also have the concern of who can the business, take to promote the business's success. We have those prosperous periods, and we want to make sure that we can safeguard our business during the tough times as well. So you think about what happens if a business owner passes away. This is a very interesting question because a lot of people are so focused on their day to day that they forget about the whole idea of the protection side. So, the desired outcome, well, business owners or business partners, they want their family to receive money in exchange for the business ownership. And the hardest part is that when you deal with family, you don't want family arguing, with surviving owners on the business valuation and all this other stuff. It just creates a lot of pandemonium and it can actually hurt the business, which is something we don't want to do. So when we think about that, we want to see for an opportunity where the business owners can find a way to help protect their business while they still have the ability to make decisions. So when you think about this, what can happen if you don't have a plan? That is a plan. It's just a very, very bad plan. So when you think about it, you have situations where heirs may think that the assessment of the business is different than what the owners think. So if I was an owner and I was dealing with someone else, say the kids of my prior business partner who passed away or the spouse, and they might think the business valuation is worth 10 million for the business. I might say it's worth 5 million for the business, so I have to pay them less. So that's where things like evaluation may be a concern for people as they are having to deal with heirs. And so a good example sake is, let's say for example's sake, myself, I own a business with a business partner as well. And when you think about it, I even had this conversation with Roderick, who I partner with on a lot of things. And Roderick and I were sitting there, and I was like, okay, so what happens when you pass away? He's like, well, my son is going to get the business. I was like, okay, does your wife know that? Yeah, with a little hesitation because it doesn't go to son, it goes to wife. Wife has an unlimited marital gift. All your assets become your spouse's assets at time of death. So you may have a great relationship with your business partner. You may not like their spouse too much. So when you think about concepts to consider, you talk about a one-way buy-sell agreement, a cross purchase, or an entity purchase, which is a hot button right now. The entity purchase, because of, I think it was the Connolly rule. There's a lot of carriers that are putting out information on that. We'll talk about that a separate time. But these are the typical ways that you would prepare your business against unwanted ownership. So the idea is you want the business to meet with their attorney to set up an agreement like a buy sell agreement or different types of buy sell agreements. And this provides some clarity at time of death. The last thing we want is nebulous uh, concerns of changes and things like that. We want everything ironclad. And then we use things like life insurance to help finance the buyout. Okay. So, what happens to the business if one of my key employees departs or passes unexpectedly? In this scenario, we want to talk about key person. Um, Before we do that, let me just kind of go back real quick. And as I was saying it, I'm like kind of overlaying things. When you talk about these type of buyout plans, I just want you to be aware that the way they're set up is different in each scenario. Okay. So when you talk about a one-way buy sell versus a cross purchase versus an entity purchase, they all have different means and ways of how they work. Um, what I'll say is that we'll see in just a minute. I just want to check with the slides first to see if they had pictures because I'm a picture guy. So we'll get into that in a minute. I just want to double check before I move on to the next concept. So the idea of buy sell is to make sure that there is no unwanted ownership in the process of a transferring of business. So what happens if one of my key employees departs or passes unexpectedly? This is now a situation where we're not focused so much on two business owners, but it's the next step in the progression. It's a business owner worried about his first line generals or her first line generals who basically run the business when they're not around. So what do we have to look at? The business owner needs to make sure that they can retain their most valuable assets, which are their employees. The objective is to ensure that most valuable employees stay so they can maintain maximum productivity and they can provide the benefit that they need to for the business. Now, if I had a employee who was so important to me that if they passed away, it would severely destroy my entire business. I want to make sure that I can protect myself as an owner. Once again, key person is still my business. I'm trying to protect my business. And so, what we want to do is we want to see if we can find the top performers, because understand if those top performers were left or passed away, you have a challenging situation where now you have to possibly even go in the red versus the black. If one of them passes away, then you want to have some type of liquidity, whether you want to sell your business or whether you want to say hire on someone new, provide maybe a bonus strategy to someone new to bring them over from, say, a competitor. But usually, when you have key person, it goes hand in hand with the executive bonus arrangement because you'll have a key employee. So, say once again, I'm worried about if I have one of my agents who is my best agent, best person that I have, and if they pass away, then I'm screwed. So I need to insure them to make sure that my business is okay. Well, they might come up to me and say, "Well, Phil, what's in it for me? You're trying to insure me to make sure that you're okay, but what about me? Am I worth it to give some type of extra incentives to compared to everybody else?" That's where the executive bonus arrangement comes in, and we have different ways of doing that. Our way is typically purchasing cash value life insurance as a bonus to the employee, and they have to stay on for the next 5 or 10 years, depending on how it's structured. The same token, you can also protect against unexpected loss with key person coverage. That is typically done with term insurance. Now, you can have a safe argument for permanent as well. I'm going to continue going through the slides. If it's not in there, I'll explain how and why you can do that. So, when we look at retirement, business owners, they intend to wind down the business, liquidate the assets once they're ready to retire. They want to get the most they can for their business. So if they are close to retirement, they hope to have some money accumulated to save for retirement. If they don't have a plan, we all know what happens. They keep working. They might have a concern that business could close, and they might have some debts as opposed to opportunities for that retirement that they're looking for. So what we have is the opportunity where they can fund a life insurance policy, provide necessary death benefit while they work, and offer that tax-free retirement strategy as well. So once again, going back to the idea of you can do this for a business owner, they personally own it, so it's not considered a business asset. But on the flip side is this is where everyone always has the same question. If I do this as a business expense, can I get a write-off? And the answer is no. Most people we talk to are LLCs, S corps, sole proprietors, partnerships. All of those are pass-through entities. So when you do these type of strategies, there are ways you can get tax deductions, but it's not if you're doing it on yourself, just so you know. So we're going to look first at the buy-sell agreements. So here's the pretty pictures. First and foremost, we talk about a cross-purchase buy-sell agreement, how it works. And it's a very simple concept. So you have two owners, and let's say the owners, I'm going to do a little handwriting here. So let's say you have owner A and you have owner B. Okay, so owner A and owner B own the business. And in this situation, unfortunately, owner B passes away. Well, now all of a sudden there's a 50% share here and a 50% share here. And we want to make sure that this person gets 100% and they don't have any say in the business. So what we do is owner B and owner A buy a policy on each other. That's where you have the cross purchase part. So I would buy owner A on owner B. I would be the owner and the insured. And owner B would buy a policy on owner A, but be the owner and the beneficiary. My apologies, I said owner and insured. So I own their policy, they own my policy. So what happens is when owner B passes away, the insurance policy pays out to me as owner A, and then I am going to pay the family for their shares. So that unfortunately for them is taxable. So they're going to pay taxes because they're selling their shares. but then I will get 100% of the company. And that's the most important part. Because again, we're trying to kick out unwanted ownership at this point. Any questions on that? Okay.
So, Phil, quick question.
Yeah.
How the death benefit the family of owner B receives it? Is it taxable?
Well, owner B is not going to get the death benefit. So when owner B passes, it's going to go to me because I'm the owner
Okay.
and the beneficiary of the policy. It's tax free for me, but then I'm going to pay them off and they have to report that because they sold shares of the business. They don't have the ability to negate that because all of this is done with actual legal documentation.
Okay.
A lot of businesses will actually put buy sells in place, but they'll forget to fund the insurance side. So from our standpoint as business professionals, we can do a free policy review of someone's buy sell, typically like 6 pages. It's nothing to write home about. So now all of a sudden, you could actually create a better value proposition to them because they might not have funded it. The other thing that a lot of people don't realize with cross purchase is disability insurance. Whether you buy a traditional disability policy, say these are doctors, hand surgeons, they might need a traditional disability policy, or if they're just regular workers and someone has a heart attack or stroke, that's when you have living benefits to accelerate, and you could potentially pay them out because they may not be dead, but they're not working. You're doing 50% of 100% of the work for 50% of the profit. So all of that goes into a buy sell evaluation.
Okay. Yeah. So technically, owner A is the beneficiary, so it's tax free for him. Whereas for the family, it's a trade of the business, so it is still taxable. Okay.
Because they're selling their shares.
Got it.
So, yep. So the question came up, could it be non-taxable if owner A pays trust versus individual? Um, Most of the time when you're building a business, you're not setting up trusts because trusts are typically designed for more personal versus business focused. And again, I think when you think about what the valuation for the business is, uh, I, I mean, if it were me, and let's just be honest, let's say I get $2.5 million and I have to pay 500,000 in taxes. I know that's a lot. Don't get me wrong. I still have $2 million that I didn't have before. Granted, I know my spouse just passed away. It's something, but it was a written agreement that they already built through the original ownership. Could there be some loopholes that could be done by either a CPA or attorney? Potentially, but I did not get a JD, so I don't think I would be the best to answer that question about trust versus individual. But it is an
Thank
intriguing.
you, Phil.
No
Thank you,
problem.
Phil. Yeah, that was my question because, like the other gentleman just mentioned, owner A gets the benefit 100% tax free versus the family itself being protected. So, if I were the other person, I would want to protect my family's interests. So, I'm just trying to understand that part.
Well, yeah, I mean, and that's a great question because keep in mind this is all business focused. You also have personal. So the great thing about talking with business owners is you're going to square away the business, but then now you go into their personal. So you want to insure the kids, you want to insure the spouse, whoever it is, because they're going to have their own personal insurance as well. This is to tackle the business and kick out unwanted owners. But as you position it to the owners to say, hey, now that we got your business all squared away, we should talk about your personal as well, and then transition from there. So the entity purchase is a little different. In the entity purchase, the situation here is really where you have, say, more than two owners. Okay, so if you had three owners, we'll keep it simple. If you had three owners The situation at hand would be, let's say myself, Jay, Tiffany, we're all owners together. Okay. So we're the three amigos, amigas, whatever you want to say. Well, in this situation, I have to buy a policy on Jay and Tiffany. Tiffany has to buy one on me and Jay has to buy one on Tiffany and me. So now we have 6 policies. It's a lot of paperwork. So in the situation, instead of us buying, 50% purchases on each person, in case someone passes away, the business buys the policy on 1, 2, 3. And the business owns it, but it is still after tax dollars. Okay. So you still have to use after tax dollars. Now, how would that work? The business would more than likely pay out the business owners. They would buy the policies, but the beneficiary would be the business. And so, from that standpoint, let's say we each have $1 million valuation as 3 owners. One person passes away. The $1 million goes back to the business to pay off the estate and then give 50-50 to the remaining 2. So it's, once again, from this standpoint, we're looking high level, keeping unwanted ownership out of the process. And this one is very unique. You have a business owner. Business owner is sole proprietor, if you will, maybe even LLC, but they have a really good person in their organization. That person wants to take over. They don't want to sell the business. They just want to take it over once this person either retires willingly or unwillingly. So let's say he passes away. We bought a policy on him to basically, once again, pay the deceased, and then you get full ownership of the business. No ifs, ands, or buts. It's all written to make sure that there's no nebulous to it. Anytime there's nebulous, you start having fights, legal issues. Just ask people like Prince's estate. I think it was Aretha Franklin. Someone had, or Tina Turner. I forget who passed away last couple of years, but there's like a cocktail napkin under a couch, and they deemed it legal. So we want to make sure that everything is buttoned up and tight. That's why with any buy-sell agreement or any agreements in general from a business standpoint, we can do business valuations. We also have insurance companies that can do business valuations for us if we don't feel comfortable enough doing it. So we kind of went through, I think I beat that like a dead horse. So we talk about the key person and executive bonus. So key person, very easy. As I mentioned before, I'm the employer. I have a top-notch employee. And as you see there, because Alex and I, we went through the same thing with many questions, premiums are not deductible by the employer. You're buying after-tax dollar insurance on the employee, so that if they die, then the employer gets tax-free death benefit to take care of the business. Now, why is that important? You have challenges to overcome, finding a replacement, whether internal or external. You have a time frame to recoup and build. You have outstanding obligations that person might have taken on, and it also maintains business continuity. So if you have someone who is that person that you always rely on, and say, for example's sake, they pass away, you got a question, are you going to keep doing the business? Are you going to train someone up? Are you going to hire someone externally? You need liquidity for that. And what's the best way to get instant liquidity? Life insurance. Most of the time, these are term sales. So some people will flip the script and say, we do permanent. Why would you do permanent on this type of situation? I'm going to ask the question to see who's still awake. And take a sip of my soda.
I'll take a stab. So is it mainly to just still build some type of dividend or cash value for the business?
Close. You're very close. It becomes part of the business valuation. So the assets inside the cash value growth can now be used for business purposes. I own the policy. My employee is just a conduit if something happens to them. But let's say they quit and leave. Well, if I was doing term insurance, that's just wasted money. But I can still pay premiums. I can still pay on that employee, even though they left. And if I need to, I can use the tax-free income and use it for building another wing on Reshco. Or if they pass away, they're a profit. That's actually what Walmart used to do to their employees. I don't know if they still do that, but they would take out insurance policies on all their employees. So there's situations where people are thinking in advance. If they pay a little, they might get a lot later. So who knows? But needless to say, is you can use that as part of evaluation for the business. But most importantly, we talk about the retention. This is where you can get some potential deductions. So you have that key employee, the one you can't live without, the one who does all the work when you're on vacation, things like that. Well, if I said to them, like, hey, I need to get a policy on you because if you die, I'm screwed. They say, well, what about me? That's where you offer this executive bonus plan. The idea is let's say I employer give employee, let's say 20K, but they have to put it in to the life insurance plan, life insurance retirement plan. Okay. The idea is they will be the owner of it. They can pick their own beneficiaries to the policy, but I don't really care too much about that. I'm going to be honest. This once again, I'm selfish. I want to make sure that my business is okay. The big thing here is that they're going to stay for at least 10 years. It's written in the contract, and life insurance is the vehicle that we use to help fund the contract. Now, here's the cool thing. You as a business owner can get a wage deduction. Okay. So if the employee receives the bonus, that is a wage deduction for you as the business owner. Now, let's say, for example's sake, you have an employee who you think will stay the whole time, but they might not. Then you could do different things like split dollar plans, where maybe they get lured away by someone else. Someone else says, I'll give you the 20,000 too. Heck, I'll give you 30,000. You can pay for that and you can supplement as well. Well, you can put the split dollar plan in that says basically that all the money you got from a bonus goes back to me before you have access to the cash. Kind of like a collateral assignment. So until I get mine, you're not getting yours. So there's different ways that you can structure it depending on how much you really love your employee or not. But it's just another strategy that people use to help keep people. Another thing you can do, they call it a double bonus. So if I want to net out 20,000 to my employee, I would figure out how much their tax is going to be and then give them a second bonus to cover the tax on the first 20,000 and that second bonus. And as I mentioned there on the prior screen, you can do restricted plans. So that split dollar agreement, which give a type of repayment obligation. So why use this as an insurance as a good bonus plan? The big one is it does increase the right employee morale for the right people. You get a tax deduction or a wage deduction, I would say. It's very easy because you would communicate with the employee on this and just that one employee. And here's the big thing too. It's not on the screen, but it's discriminatory. I probably spelled that wrong, but we won't let the grammar get in the way. I can give this to whoever I want, and I don't have to give it to everybody. Jay, you had a question?
Yeah, in the previous slide, somewhere we have seen about, can you go one more slide before? Yeah, so on the step number 2, the payments are deductible as long as the amounts are reasonable. Is there a specific percentage, how much percentage of their salary or pay they are receiving from the business is ideal for this?
I'd say probably you'd be okay with probably about 20%. You know, you can't give like a janitor making 10 grand a year $100,000 bonus. But you know, in the world of like when I worked at AIG as a director, I made I had $100,000 salary and they gave me a $18,000 bonus if we hit all our measurables for the year. So those were that would be what you would consider reasonable. Even you know maybe 30,000 would be reasonable, but if it was 100,000 and I got 100,000 as a bonus, they might question that. So the other thing, and I'll dovetail on this, was that did that answer your question though?
Yeah, that is yes, but how will the insurance company really know that, how much the bonus is coming up? Because this is just the
Well,
payroll part of it.
well, you have to mention on the application the salary. So, you know, you have to tell the annual salary for you and your spouse every time you do an insurance policy. So that's where you'll have that situation where it'll tell you how much you can actually bonus, and the carrier will make sure that you're not over bonusing, so to speak. So they might say, based on your client's annual salary, the most they can get is 20,000, 30,000, or whatever. So you'll have a situation where they'll put the kibosh on it too from the underwriting side. Now between us people on this call and whoever watches this after, you know, who's to say that, you know, on most of the time when you're doing someone's salary, you're putting it on based on what they're telling you. I don't look at people's W-2s. So if they say they make more, they don't. I'm not one to judge. I don't know. I'm just basing it off of what they're telling is the truth. Now,
Okay,
is that fair?
yes.
Okay. Now, it does raise a good question though, because in this scenario, when you think about it, now some people, when we go back to the idea of a tax deductible contribution, the tax deductible contribution, you have the opportunity to get a tax deductible contribution by giving it to an employee. Now, let's say over here you have husband and over here you have wife. Do you get the tax deduction for this? You want to answer?
Yeah,
You think so?
yeah, that's good.
Okay. Anybody else? You don't. And the reason is if you have an LLC or an S corp, those are all pass-through entities to your personal. So if you file married, filing jointly, then that bonus just got put into your personal. So there's no benefit to do it to your spouse. You have kids, your kids are taking over the business, they have their own taxes, they're no longer dependents. You can do this strategy and get a deduction. But there's no point in doing it for your spouse. Matter of fact, if it's a husband and a wife or spouses, you know, just to be gender appropriate, you would rather do it as a personal LERP versus a executive bonus plan because there's really no benefit. So just kind of keep that in mind when you talk to business owners. A lot of them are family oriented, but if you want to get the deduction, it has to be someone not in your tax position. Because if you're giving it to your spouse, then there's no point in doing it. It would just be better doing it personal because you could get higher limits to face amounts and things like that too. So kind of a baited question, so I apologize. But yeah, that's the main thing to remember, is when you're dealing with LLCs and S corps, the people are always, anytime you talk to a business owner, they're like, hey, I want tax deductions. You go in there saying, hey, I can show you tax deductions. And then they're like, all right, cool, let's do this LERP plan. And you're like, awesome. Who are you going to do it on? My wife. You're like, ugh. So that's where you miss out on that opportunity. So just understanding some of it, and they say, well, I think I can do it. Say, well, that's up to you and your CPA. That's where you back off. Because if their CPA can find some magic rules, and you just don't want any part of that. Now, we can offer tax deduction opportunities, as I showed you here, the wage deductions, for someone who is not in your lineage and not on your tax bill at the end of the year. Again, we can do 401ks. We can do solo 401ks all the way up to about 300 employees. So we have different avenues that we can go to give different types of tax deductions. Not talking about that today, but once again, that is important to remember from that standpoint. So when we think about everything we're doing here, once again, the whole idea is to maintain and protect the business owner. It's always about what we're doing for the business owner. So these executive bonus plans, the idea is to recruit, reward, and retain. We're even talking to University of Alabama to talk about executive bonus plans for their top football players with these contracts that they're getting to play college football. So you have different ways that you can use this executive bonus plan. It is a great strategy, often used, just not often talked about. A lot of the solutions that we have are often used, just not often talked about. And so just kind of wrapping up again, what we talked about from the beginning, buy-sell agreements, owners protecting against unwanted ownership. So we have 2 owners, 3 owners, 5 owners, whatever. One passes away. You don't want the spouse getting that ownership, but they will automatically get that ownership. You have to buy them out. Buy-sell agreement. Key person, you got a key person that you can't live without. You buy insurance on them that if they pass away, you can stay in the black, sell your company, or build, retain, and buy someone new, or recruit someone in, whatever, with a nice bonus. But then that key person's kind of mad. They're like, why are you buying insurance on me? For your benefit. What about me? Executive bonus. Retain, recruit, grow. And that's the way you can do that from that standpoint as well. So those are the 3 major ones. And once again, for those who kind of popped in late, I just want to reiterate what I showed people in the beginning is not my kids. Sorry. I had this up. It went missing. All right, the newsletter. Just to go through again, we set up a Telegram page. So if you want to get in there so you can see any updates, we can throw them in there as well. That way there's an opportunity to find it all in one spot. If not, I'm sending these out on a weekly basis. This is the new meeting link, so encourage your team to get on here as well. We're doing roadshows, so again, the opportunity for you to grow your organization. If you are in the mood to increase the value proposition, we're doing one in Chicago, 8/17, in Naperville, Illinois. Then we're going to do one in Orlando, Dallas again, and then Atlanta. Now, these are not these big rah-rah conventions. They are presentations, opportunities for people to grow, find ways to partner with us. Remember, we can sell life, annuities, long-term care, disability. That's one silo. ACA, Medicare, group life, group health. That's another silo. And then alternative investment strategies with contractually fixed double-digit returns. That's silo number 3. We have ways where we can holistically help the end consumer And that's what the collaboration is about. You might know people who work in one field, but they don't work in a different field with you. And now you have an opportunity to bring them in and grow the bottom line. We have limited seating available in Chicago, about 30 seats available there. We're looking between 20 to 50, give or take, in each location. So just to give you a heads up, this is the schedule. You'll see these come out in the newsletter, along with the schedule of the training stuff. Coming up next week, we talk with a company called Paylocity. They're going to come in and talk about the value of what they can provide, being the fact that they have access to businesses. They're a payroll company. And by partnering with them, you have the opportunity to, let's say, move 401ks over. So right now, through a strategic partnership, there's about a 250 employee office that is moving from ADP over to Paylocity. And Robin, who's coming on, is going to introduce me to that organization to work on a 401k. I get a rollover commission, and I'll get continual income coming from when people put deposits in. And once again, the company we work with does very well for small businesses, so it'll save the company on fees as well. So we have great stories from that standpoint coming up. And then coming in for the third quarter, we're going to deep dive into living benefits, traditional long-term care. And then after that too, we'll talk about these hybrid products, like Nationwide has one, Lincoln has one, Securian has one. Those are linked benefit products. And then we'll also talk about riders that are attached to life insurance policies. So a lot of good stuff coming up from a training perspective, also from a in-person perspective. So depending on where you're at, and if you want to grow, we're going to have some great stories and great opportunities. So keep an eye out for the calendar. Sign up for the Telegram if you want to get some updates that are sometimes quick and dirty there. New products coming out. Symetra has a Swift Protector product. Allianz has a new product coming out. And then also, as I mentioned to some people in the beginning, I'll say it again. We all have social networks, and if we want to grow this thing, we have an opportunity to do so. If I see people posting stuff, I will gladly like it, forward it, and help you grow your network with my people. Would love for you guys to do the same so we can do a grassroots promotion and get people moving, get better opportunities, and grow this thing. We've done tremendous things in 2 years, less than 2 years, and I can only see the value going up from here still. So any questions on the newsletter stuff? Any questions on what we talked about? Was this helpful? All right, I got a claps. I'll take a claps. I like that. So I'm going to post this up on the YouTube channel. Always a pleasure. And if you have any questions, you can look and see it up there. We'll be sending out a newsletter sometime between now and Monday. So thank you guys. Hope you have a great weekend. And oh, thank you, Tiffany. We'll talk soon, guys. Okay. Thank you.
Thanks, Phil.